So what do we make of the market reaction, in particular, the move or very little move in bonds, in yields, that is? Yields came down a little bit. Dollar came down a little bit during his testimony, Tim.
I think it tells you what, first of all, the lack of volatility in the bond market is something I think the equity market loves. And I think the fact that you're somewhat range bound here in terms of the 10 years is not terribly surprising because, again, inflation expectations haven't really changed. They've been kind of in line. I would even look at the DEC Fed Fund futures and we've moved about 9 or 10 basis points in terms of the short end of the curve. So it's not like you've suddenly priced in runaway. But I thought Powell today, unofficially, of course, ratified the Fed speak of the last few days, and certainly Waller and Bowman. And I think this is a case where when he's asked in question, hey, could you guys move in July? And he says something along the lines of, as long as inflation measures stay contained, that gives the market all they need to know. And again, war is war and it's awful. The market is more focused on the Fed and has been for the last 3 or 4 trading sessions.
I think that on the margin, he was a little bit more dovish, actually. And the reason I say that is he's basically saying if I get lower inflation reads, which is what he's been saying, but we get one this Friday, PCE, right? We have Fed minutes July 9th. Normally, that's a nothing burger. It already happened in the past, but you get a better idea of what was talked about in that meeting. And my whole thing is this. The meetings are every 6 weeks for the Fed. So if he doesn't do anything, he can go 50 basis points the next meeting. So I'm with you. I wouldn't cut yet because we don't have enough information. But he basically said he would have already cut 100 basis points potentially. That would be what would be built in if it weren't for the tariffs.
Yeah, to your point, we have CPI July 15th, and we have the Fed meeting July 30th, and we know that the favorite thing. Are you going to be in Jackson Hole late August, guy? For the big Fed confab there. And that has been historically something where you see a bit of a shift.
Messaging.
Messaging. And Tim just mentioned what we've seen in the CME FedWatch tool. You've seen, I think it was pricing in maybe at 14% or something like that. Now it looks like a 20% of a 25 basis point cut at the July meeting. I mean, there are a couple scenarios where you can see a slightly more dovish tone here and there, a little bit more pressure from some of these other Fed governors, and then all of a sudden it looks like maybe it's a toss-up. What will the stock market be discounting, though, at this point if we're at 6150, 6200 or something like that? It might be a bit of a sell the news, and then you have to go back and say, what are the reasons in which they're doing this? Last year in September, they were doing it because they were worried about the jobs market. Guy and I just had a conversation with David Rosenberg Research, Rosie. He thinks there is considerable weakness in the housing market, in the jobs market, that is not being reflected in some of the data that we've seen. And you may say, well, he's, does that from time to time. Well, he's done it a couple times from time to time, as long as I've been following him, when he's been actually spot on, when no one else has actually recognized some of the things that he's doing. So, again, the jobs is going to be important, some of the inflation data. And he's not even worried about inflation, by the way. He just thinks some of the underpinnings of the economy are
How would that
weak.
weakness be masked?
Well, he'll break down just some of the data as it relates to what the Fed chair is saying about the employment, picture and what he sees below in some of this, sort of softer data, if you will. And he thinks it's going to become hard data in the not so distant future.
The home builders suggest exactly that. But getting back to the market, 400 points ago, Tim on the show said the pain trade is going to be higher. And here we are with 50 handles away from an all-time high. That's clearly been the case. But at what point, clearly not now, but do valuations in potentially a slowdown matter? Because we have gotten ourselves back to 23 times next year's earnings in terms of the S&P 500. We just heard from FedEx. I'm sure we'll talk about it. The home builders suggest something else is going on. A variety of retailers are telling a similar story. I just think the market, in terms of risk reward and being expensive, is at the wrong end of the ship right now.